For chapter 1, you can see Tavis sir's class. Here he has already uploaded the chapter 1 of the theory questions. It's the most important chapter, but from chapter 2 to 15, it's considered this as an audio book. Chapter 2, Material Costing. Write down the treatment of following items associated with purchase of materials. Cash discount. Cash discount is not deducted from the purchase price. It is treated as interest and finance charges. It is ignored. IGST. IGST is excluded from the cost of purchase if credit for the same is available. Unless mentioned specifically, it should form part of the cost of purchase. Demurrage. Demurrage is a penalty imposed by the transporter for delay in uploading or offloading of materials. It is an abnormal cost and not included with the cost of purchase. Shortage. Shortage in materials are treated as follows. Shortage due to normal reasons. Good units absorb the cost of shortage due to normal reasons. Losses due to breaking of bulk, evaporation, or due to unavoidable conditions, etc. are the reasons of normal loss. Shortage due to abnormal loss. It should be debited to costing P&L account. Shortage arises due to abnormal reasons such as material mishandling, pilferage, or due to any unavoidable reasons are not absorbed by the good units. Basic customs duty. Basic customs duty is paid on import of goods from outside India. It is added with the purchase cost. Trade discount. Trade discount is deducted from the purchase price if it is not shown as deducted in the invoice. Cash discount is not deducted from the purchase price. A penalty. Penalty of any type is not included in the cost of purchase. Insurance charges. Insurance charges are paid for protecting goods during transit. It is added with the cost of purchase. Commission paid. Commission or brokerage paid is added with the cost of purchase. Which system of inventory management is known as demand pull or pull-through system of production? Explain. Also specify the two principles on which the system is based. The system is just-in-time inventory management, JIT. It is also known as the demand pull or pull-through system of production. In the system, production process actually starts after the order of the products is received. It's a system of inventory management with the approach to have zero inventories in stores. According to this approach, material should only be purchased when it is actually needed for production. JIT is based on two principles. Produce goods only when it is required, and the product should be delivered to customers at the time only when they want. Distinguish between bin cards and stores ledger. First I will say bin card, then stores ledger. Bin card. It is maintained by the storekeeper in the store. Stores ledger. It is maintained in cost accounting department. Bin. Only quantitative details of materials received, issued, and returned to stores are having bin card. Stores ledger. It contains information both in quantity and value. Bin card. When transaction takes place. Entries are made when transactions take place. Stores ledger is always posted after the transaction. Bin card. Each transaction is individually posted. Stores ledger. Transaction may be summarized and then posted. Bin card. Inter-department transfers do not appear in bin card. In stores ledger, material transfers from one job to another job are recorded for costing purposes. Stated reasons statements are true or false. Under LIFO method, the period of falling prices, lower income is reported and income tax liability is reduced. False. Under LIFO method, in case of falling prices of profit tends to rise due to lower material costs, the income tax liability is increased, not decreased. Under VED analysis, inventories are classified on the basis of cost of items. False. Under VED analysis, inventories are classified on the basis of its criticality for the production and function and for the production function and final production. Third question. Material requisition notice prepared by the storekeeper. False. Material requisition notice prepared by the production or other consuming department. It is a voucher used to get material issue from store. Fourth one. Simple average pricing method is suitable when quantity purchased under each lot is different and prices fluctuate considerably. Simple average price, it's also a false answer. Simple average pricing method is suitable when the materials are received in uniform lots of similar quantity and prices do not fluctuate considerably. Last one. Bin cards and stores ledger are maintained by the purchasing department. False. Bin cards is maintained by the storekeeper in the stores, while stores ledger is maintained in cost accounting department. Distinguish between waste and scrap. Waste. The portion of raw material which is lost during storage or production and discarded. Scrap. The output which is discarded and disposed of without further treatment. Waste. It is connected with raw materials or inputs to the production process. Scrap. It is a loss connected with the output. Waste. Waste of materials may be visible or invisible. Scrap. Scraps are generally identifiable and has physical substance. Waste. Generally, waste has no recoverable value. Scraps. Scraps are termed as byproducts and has small recoverable value. Treatment of scrap. Normal scrap. Normal. The cost of scrap is borne by good units and income arises on account of realizable value is deducted from the cost. Abnormal. The scrap account should be charged with full cost. The credit is given to the job or process concerned. The profit or loss in the scrap account on realization will be transferred to the costing P&L account. Additional questions for practice. State how normal and abnormal loss of material arising during storage are treated in cost accounts. Shortage in materials is treated as follows. Shortage due to normal reasons. Good units absorb the cost of shortage due to normal reasons. Losses due to breaking of bulk evaporation or due to any unavoidable conditions are the reasons for normal loss. Shortage due to abnormal loss. Shortage arises due to abnormal losses reasons such as material mishandling, pilferage, or due to any unavoidable reasons are not absorbed by the good units. Losses due to abnormal reasons are debited to costing P&L account. Discuss the accounting treatment of defectives in cost accounts. It signifies those units of portions of production which do not meet the quality standards. Defectives arise due to substandard materials, bad supervision, bad planning, poor workmanship, inadequate equipment, and careless inspection. The defectives which can be remade as per the quality standards by using additional materials are known as reworks. Reworks including repairs, reconditioning, and refurbishing. Defectives which cannot be brought up to the quality standards are known as rejects. The rejects may either be disposed of or recycled for production process. Treatment of defectives. Normal. An amount equal to the cost less realizable value on sale of defectives are charged to material cost of the good production. Abnormal. Material cost of abnormal defectives are not included in the material cost but treated as loss after giving credit to the realizable value of such defectives. The material cost of abnormal loss is transferred to costing P&L account. Question number 9. Explain the concept of ABC analysis as a technique of inventory control. ABC analysis system exercises discriminating control over different items of inventory on the basis of investment involved. Usually, the items are classified into 3 categories according to their relative importance, namely their value and frequency of replenishment during a period. A category. This category of items consists of only a small percentage, that is about 10% of the total items handled by the stores but requires heavy investment, about 70%. Small percentage is 10%, investment is 70%, volume 10%, value 70% of inventory value because of their high prices and heavy requirement or both. Items under this category can be controlled effectively by using a regular system which ensures neither overstocking nor shortage of materials for production. B category. This category of items is relatively less important. They may be 20% of the total items of materials handled by the stores. The percentage of investments required is about 20% of the total investment in inventories. In the case of these items, as the sum involved is moderate, the same degree of control as applied in a category of items is warranted. Both are 20. Investment and value. Volume and value both are 20%. Category C category. This category of items do not require much investment. It may be about 10% of total inventory value, but they are 70% in total items. Volume 70%, value 10%. For these categories of items, there is no need of exercising constant control. 10th one, distinguish between reorder level and reorder quantity. Reorder level or reorder stock level. This level lies between minimum and maximum levels in such a way that before the material ordered is received into the stores, there is sufficient quantity in hand to cover both normal and abnormal consumption situations. In other words, it is the level at which fresh order should be placed for replenishment of stocks. Formula: reorder level equal to maximum usage rate into maximum lead time. Reorder quantity. Reorder quantity is the quantity of materials for which purchase requisition is made by the stores department. While setting the quantity to be reordered, consideration is given to the maintenance of minimum level of stock, reorder level, minimum delivery time, and most important, the cost. And the quantity should be where the total carrying cost and ordering cost is at minimum. For this purpose, economic order quantity should be calculated. Question number 11. Explain how we slow and non-moving items of the stocks detected and what steps are necessary to reduce such stocks. Fast moving, slow moving and non-moving inventory. It is also known as FNS, fast, normal and slow moving. Classification of inventory analysis. Under this system, inventories are controlled by classifying them on the basis of frequency of usage. The classification of items into these three categories depends on the nature and managerial discretion. A threshold range on the basis of inventory turnover is decided and classified accordingly. Fast moving. This category of items is placed nearer to store issue point and stock is reviewed frequently for making of fresh orders. Slow moving. This category of items is stored little far and stock is reviewed periodically for any obsolescence and may be shifted to non-moving category. Non-moving. This category of items is kept for disposal. This category of items is reported to the management and the appropriate provision for loss may be created. Some of the reasons for slow and non-moving inventories are stated below. Failure of production management to communicate the updated requirement to the store's management. Technological upgradation in terms of new machine requiring new kind of material or existing material becoming obsolete. Lack of periodic review of inventories. By careful observation, timely identification and adoption of inventory management techniques such as maintenance of minimal level or just-in-time approach, one can manage slow-moving and non-moving inventories. We may calculate inventory turnover ratio and present the reports of comparison of actual and standard with variations, if any, to the management. Short notes on the following. Danger level. It is the level at which the normal issues of raw material inventory are stopped and emergency issues are only made. It can be calculated as danger level equal to average consumption into lead time for emergency purchase. Average consumption is sometime minimum consumption is also used instead of average consumption. Then the formula will be minimum consumption into lead time for emergency purchase. JIT management. JIT is a system of management inventory with an approach to have zero inventories in stores. According to this approach, material should only be purchased when it is actually required for production. JIT is based on two principles. Produce goods only when it is required and products should be delivered to customers at the time only when they want. It's also known as demand pull or pull-through system of production. Maximum stock level and minimum stock level. It is the highest level of quantity for any material which can be held in stock at any time. Any quantity beyond this level costs extra amount of expenditure due to the engagement of fund. Cost of storage, obsolescence, etc. It can be calculated as below. Maximum level equal to reorder level minus minimum usage into minimum lead time plus reorder quantity. Here reorder quantity may be EOQ also. Obsolescence. Obsolescence is defined as the loss in the intrinsic value of asset due to its suppression. In simple words, obsolescence refers to the loss in the value of an asset due to technological advancement, like an impairment. Materials may become obsolete under the following circumstances: where the spare part of component of a machinery that is used in manufacturing and is now obsolete, where it is used in the manufacturing of product which has now become obsolete, where the material itself is replaced by another material due to either improved quality or fall in price. In all three cases, the value of obsolete material held in stock is a total loss and immediate steps should be taken to dispose it of at the best available price. The loss arising out of obsolete materials is an abnormal loss and does not form part of any cost of manufacture. Write short notes on VED analysis. Vital, essential and desirable, that is VED. Under this system of inventory analysis, inventories are classified on the basis of criticality for the production function and final product. Generally, this classification is done for spare parts which are used for production. It's like ABC only. Vital items are classified as vital when this unavailability can interrupt the production process and cause a production loss. Items under this category are strictly controlled by sitting reorder level. Essential items under this category are essential but not vital. The unavailability may cause substandardization and loss of efficiency in production process. Items under this category are reviewed periodically and get the second priority. Desirable items under this category are optional nature. Unavailability does not cause any production or efficiency loss. 15 minutes or over. Second chapter is over. So, third chapter, employee cost and direct expenses. Question number 1. Explain the treatment of overtime premium in following situations. SV and company wants to grab some of the special orders, and overtime is required to meet the same. If overtime is required to cope with the general production programs or for the meeting urgent orders, the overtime premium should be treated as overhead cost of the particular department or cost center which works overtime. Department X has to work overtime to make up a shortfall in production due to some of the fault of management in Department Y. If overtime is worked in a department due to the fault of another department, the overtime premium should be charged to the latter department, that is Y. S Limited has to work overtime regularly throughout the year as a policy due to the workers' shortage. The overtime premium is treated as a part of employee cost and the job is charged at an effective average wage rate. Due to flood in Odisha, RS Limited has to work overtime to complete the job. Overtime work on account of abnormal conditions such as flood, earthquake, etc. should not be charged to cost but to costing P&L. A customer requested the company MN Limited to expedite the job because of his urgency of work. Or the overtime is worked at the request of the customer. Overtime premium is also charged to the job or customer directly. How does the high employee turnover increase the cost of production? Explain. High employee turnover increases the cost of production. Replacement costs are the costs which arise due to employee turnover. If employees leave soon after they acquire the necessary training and experience of good work, additional cost will have to be incurred on new workers, that is cost of recruitment, training and induction, abnormal breakage and scrap, and extra wages and overheads due to the inefficiency of new workers. It is obvious that company will incur very high replacement cost if the rate of employee turnover is high. Similarly, only adequate preventive cost can keep employee turnover at a low level. Each company must therefore work out the optimal level of employee turnover, keeping in view its personal policies and the behavior of replacement cost and preventive cost at various level of employee turnover rates. Explain what is meant by practical capacity and normal capacity. How is normal capacity determined? Practical capacity. Practical capacity is defined as actually utilized capacity of a plant. It is also known as operating capacity. This capacity takes into account of lost time due to repairs, maintenance, minor breakdown, idle time, setup time, normal delays, Sundays and holidays, stock taking, etc. Generally, practical capacity is taken between 80 to 90% of rated capacity. It is also used as a base for determining overhead rates. Practical capacity is also called net capacity or available capacity. Normal capacity. Normal capacity is the volume of production or services achieved or achievable on an average over a period under normal circumstances, taking into account the reduction in capacity resulting from plant maintenance. Normal capacity is determined as under installed capacity adjustments for time loss due to schedule preventive or maintenance, number of shifts in man hours, holidays, normal shutdown days, normal idle time, normal time lost in batch ചേഞ്ച് ഓവർ എല്ലാം കുറയ്ക്കുക. അപ്പോൾ എന്ത് കിട്ടും? നോർമൽ കപ്പാസിറ്റി കിട്ടും. Installed capacity, do these adjustments and then we will receive normal capacity. How would you account for ideal capacity cost in cost accounting? Ideal capacity costs are treated in the following ways in cost accounts. If the ideal capacity cost is due to unavoidable reasons, a supplementary overhead rate may be used to recover the ideal capacity cost. In this case, the costs are charged to the production capacity utilized. The ideal capacity cost is due to avoidable reasons such as faulty planning, etc. The cost should be charged to costing P&L account. If the ideal capacity cost is due to trade depression, etc., being abnormal in nature, the cost should also be charged to the costing profit and loss account. If the ideal capacity cost is due to seasonal factors, then the cost should be charged to cost of production by inflating overhead rate. Brief out advantages and disadvantages of HALSI premium plan. Advantage: time rate is guaranteed while there is opportunity for increasing earnings by increasing production. The system is equitable in as much as the employer gets a direct return for his efforts in improving production methods and providing better equipment. Disadvantages: incentive is not so strong as with the piece rate system. In fact, the harder the worker works, the lesser he gets per piece. The sharing principle may not be liked by employees. Question number 6. Set various costs and treatment of overtime premium in cost accounting. Situation: if overtime is worked at the request of customer, if overtime is resorted at the desire of the customer, then the overtime premium may be charged to the job directly. To cope with general production program, this question is a repetition. Say the direct expenses with examples. Expenses other than the direct material cost and direct employee cost, which are incurred to manufacture a product or for provision of service and can be directly traced in an economically feasible manner to a cost object. The following costs are examples of direct expenses: royalty paid or payable for production or provision of services, hire charges paid for hiring specific equipment, cost for product or service specific design or drawing, cost of product or service specific software, other expenses which are directly related with the production of goods and provision of services. What do you mean by employee productivity? Point out the factors which must be taken into consideration for increasing employee productivity. Meaning of employee productivity. Productivity is generally determined by the input or output ratio. Input output ratio. In case of employees, it is calculated as standard time for doing actual work divided by actual time taken. Employee productivity is used for measuring the efficiency of individual workers. It is an index of efficiency in the utilization of human resources, materials, capital, power, and all kinds of services and facilities. It is measured by the output in relation to input. Productivity can be improved by reducing the input for a certain quantity or value of output, or by increasing the output from the same given quantity or value of output. Question number 9. Describe briefly idle time and explain the treatment of idle time in the cost accounts in following situations. The setting up time for machine in case of direct worker Mr. A. Idle time. Normal idle time. Treatment. It is treated as a part of cost of production. It is to be considered while setting of the standard hours and or standard rate. Normal rest time, break time for lunch in case of indirect worker Mr. B. It is also a normal idle time. It is to be considered for the computation of overhead rate. Time loss due to breakdown of machine in case of the worker Mr. C. Abnormal idle time. It is to be shown as a separate item in the costing P&L account. Chapter number 2 is over. 3 is over. Chapter 4. Overheads and absorption costing method. Suggest any one basis of reapportionment of services, service department overhead, production departments in the following instances. Maintenance and repair shop basis: direct labor hours, machine hours, direct labor wages, asset value into hours, etc. Hospital and dispensary: number of employees, number of direct workers, etc. Fire protection: capital values. Stores department: number of requisitions, weight or value of material issued. Transport department: crane hours, truck mileage, truck tonnage, truck ton hours, tonnage handled, number of packages of standard size, etc. Computer section: computer hours, specific allocation to departments. Power hours, otherwise electric power cost. Horsepower, kilowatt hour, that's kWh. Horsepower into machine hours, kilowatt hour into machine hours. Inspection hours, common number of inspections. Tool room: direct labor hours, machine hours, direct labor wages, asset value into hours worked. Timekeeping: number of card punched, number of employees. Question number 2. Explain the treatment of over and under absorption of overheads in cost accounts. Treatment of over and under absorption of overheads are: writing off to costing P&L. Small difference between the actual absorbed amount should simply be transferred to costing P&L account. If difference is large, then investigate the causes, and after that abnormal loss or gain should be transferred to costing P&L account. Use of supplementary rate. Under this method, the balance of under or absorption overheads may be charged to cost of WIP. Finished stock and cost of sales proportionately with the help of supplementary rate of overhead. Carry forward to subsequent year. Difference should be carried forward in the expectation that the next year the position will be automatically corrected. Question number 3. Distinguish between cost allocation and cost absorption. Cost allocation is the allotment of whole item of cost to a cost center or a cost unit. In other words, it is the process of identifying, assigning, or allowing cost to a cost center or cost unit. Cost absorption or cost apportionment: it is the process of absorbing all indirect cost or overhead cost allocated or apportioned over particular cost center or production department by the units produced. Chapter number 5. Activity based costing. Question number 1. PP Limited is in the process of implementing activity based costing in the organization. For this purpose, it has identified the following business functions in its organization: research and development. Cost driver. What is the cost driver? That is the question. Research and development: number of research projects, personal project hours on a project, technical complexities of the project. Next one: design of products, services and procedure, number of products in design, number of parts per product, number of engineering hours. Customer service, number of service calls, number of products serviced, hours spent on servicing products. Marketing, number of advertisement, number of sales personnel, sales revenue. Distribution, number of units distributed, number of customers, weight of items distributed. Question number 2. What is meant by activity-based management, and discuss how activity-based management can be used in business. Meaning of activity-based management. The term activity-based management is used to describe the cost management application of ABC. The use of ABC as a cost tool to manage cost at activity level is known as activity-based management. ABM is a discipline that focuses on the efficient and effective management of activities as the route to continuously improving the value received by customers. ABM utilizes the cost information gathered through ABC. Activity-based management can be used in following ways. Cost reduction. ABM helps the organization to identify cost against activities and to find opportunities to streamline or reduce the cost or eliminate the entire activity, especially if there is no value added. Business process reengineering (BPR) involves examining business processes and making substantial changes to how organization currently operates. ABM is a powerful tool for measuring business performance, determining the cost of business output, and is used as a means of identifying opportunities to improve process efficiency and effectiveness. Benchmarking. Benchmarking is a process of comparing of ABC derived activity cost of one segment of company with those of other segments. It requires uniformity in the definition of activities and measurement of their cost. Performance measurement. Many organizations are now focusing on activity performance as a means of facing competitors and managing costs by monitoring the efficiency and effectiveness of activities. Question number 3. Write down the corresponding cost drivers related to the following activity cost pools. Inspecting and testing cost, setting up machine cost, machining cost, supervising cost, ordering cost, receiving material. Inspecting and testing cost, number of tests. Setting up machine cost, number of setups. Machine cost, machine hours. Supervising cost, direct labor hours. Ordering and receiving materials, number of purchase orders. Question number 4. What is meant by cost driver? Give it the different categories such as suitable cost drivers. Distribution, research and development, customer service. Meaning of cost driver. A cost driver is a factor variable which affect level of cost. Generally, it is an activity which is responsible for cost incurrence. Level of activity or volume of production is the same example of cost driver. An activity may be an event, task, or unit of work, etc. There are 2 categories. Resource cost driver. It is a measure of quantity of resources consumed by an activity. It is used to assign the cost of a resource to an activity or cost pool. Activity cost driver. It is a measure of frequency and intensity of demand placed on activities by cost objects. It is used to assign activity cost to cost objects. Business function, distribution cost drivers, number of units distributed, number of customers, etc. Research and development cost driver, number of research project, person levels of a project, technical complexities of project. Customer service, number of service calls, number of product serviced, hours spent in servicing of product. Then chapter 2, 3, 4 and 5 is over. 6 to 15 will be in the next video.